can't get access to the cash and credit that they need. And so we are going to see some casualties of that on the business side as well.
Greg, this is Emily. I want to ask a little bit about the fiscal stimulus that could be coming down the pipeline. What do you think needs to be included in that package to really assuage markets at this point?
That's very difficult to say simply because at the root of this is a health crisis. It's not a financial crisis. And, the fallout that we're seeing economically and in markets is a result of a health crisis. So, I think, markets are probably going to want some greater clarity with regard to the health side of things. And as we see, have greater certainty there, as there's less concern and worry and unknowns, then markets and the economy kind of take the cue from there.
Well, Greg, when we're talking about all these responses right now, because there's so many unknowns, it is still interesting to see how the Fed is planning to respond. Of course, we're just 5 days away from that FOMC decision. Right now, the market's still pricing in about a 75% chance that we will return to a zero interest rate policy, which we haven't seen since the Great Recession. But when we look at President Trump still applying pressure to the Fed, this morning he was writing on Twitter about the Federal Reserve, saying that they must finally lower the Fed rate to something comparable to their competitor central banks. Jay Powell and group are putting us at a decided economic and psychological disadvantage. Should never have been this way. Also stimulate. The New York Fed said they will be accelerating their purchases of treasuries, buying around $33 billion of bonds today. And we saw that boost to repo operations yesterday. So what are you making of that, the financial plumbing here? Because even just hearing from some mortgage lenders around the country, such volatility is kind of making their job difficult when we think about mortgage rates. We saw a boost, a big spike in terms of refinancing. So what do you think about all of that going on here?
Well, the significant step is what we saw from the New York Fed yesterday, and we're going to see more of that those interventions to make sure that there is cash and credit available in the system so that we don't have a repeat of 2008. Yesterday we saw the stock market sell off by 10%, and what happened? Treasury yields went up, not down, and that's indicative of a cash grab. People were selling everything they could because to get their hands on cash. Anybody who has got a line of credit's drawing it down. Banks are loading up the coffers so that they can meet that demand. That's where the Fed is going to have to continue to be very active, monitoring markets and intervening as necessary so that markets function properly. We're on a pathway to 0% interest rates, but at this point it's pushing on a string, right? 0% interest rates isn't going to make sick people well. It's not going to, get ball games to be played again, right? This is at the root of it, a health crisis. But the Fed moving rates lower in an aggressive fashion again, as they will do, I think that meets the expectations and helps ease a little bit of concern in the market. But that's largely symbolic at this point.
Yeah, absolutely. And next week, not just the rate cut potentially where we land there, but also potentially return to QE as well. More quantitative easing coming from the Fed might be something that investors are hopefully awaiting here as well. But for now, Greg McBride, thank you so much for joining us. Appreciate it. Meantime, the coronavirus pandemic is also weighing heavily on entertainment companies like Disney. The media and entertainment giant announcing last night it would be temporarily closing Walt Disney World in Orlando, Florida, along with its Disneyland theme parks in both California and Paris through the end of the month. Universal Studios in Hollywood and Orlando also announced it would be shutting down as coronavirus cases continue to rise. And joining us now is former Disney senior analyst in corporate strategy and business development, Kelly O'Grady. Kelly, it's good to see you. Interestingly, Credit Suisse cut their price target on Disney by $13 to $150 a share, saying that the park closures are likely to be about a $2.2 billion drag on the full year for Disney. So how big of a hit do you think that this becomes?
So listen, overall, I think that this is a really smart decision. Like, the biggest asset that Disney has is its brand. The worst thing that you could possibly see is Mickey associated with the coronavirus. But I do think that we're going to see, implications on the financial results at the end of the year. So I don't blame Credit Suisse for doing this. This isn't just going to be about the 2-week shutdown that's happening there. It could be longer, but you're also going to see repercussions with ticket prices and whatnot potentially lowering. And you might also see families deciding, hey, this might not be the year to go to Disney. This is not the time to spend all of the money that was saved. Maybe we'll do it next year. So I think that this could really, really affect not just the immediate shutdown, but the rest of the year as well.
Yeah, overall, I mean, park revenue is about a third of Disney's revenue. It comes from that stream of the business. So, I mean, it is clearly significant here. But from your time there and working at Disney, how much of a spillover effect could there be in the way that park attendance ties into other revenue streams as well?
Yeah, absolutely. I mean, as you say, it's a third of the revenue, but 45% of the operating income. So this is really the cash cow. So the thing is that Disney is such an integrated company. It's its strength, but this could be the downside. Parks are not only driving those magical experiences for family and the brand equity that comes from it, but it also plays into the the marketing for the films. This summer, you have some major releases coming out. You've got Mulan, you've got Jungle Cruise, which is actually a movie based on a park ride. And so I really think it's going to cause a problem with some of their marketing, with their consumer products, revenue that they were expecting against these big tentpole films for them. So this could really not only just affect the park segment, but also all the other segments as a whole.
Yeah.
And interestingly, their Disney Plus launch was huge, but it's not expected to be profitable for some time. And so that 45% of OI coming from parks is really supposed to balance things out for them.
Kelly, comparing Disneyland to some of these other discretionary categories like restaurants, leisure, a lot of analysts are saying that there might not be this huge recovery because, if a family doesn't go out to a restaurant this week, it doesn't necessarily mean they'll go out twice next week when things clear up. So is Disney in that same category where they might not necessarily see that, build up in demand come to fruition and cause a surge in subsequent quarters?
That's a really interesting question. I think so many families that go to Disney, right? The median family that goes to Disney saves up for years. And so thinking about, okay, are they going to pull the trigger right now for their trip in September? Or are they going to wait and say, hey, let's see how this all pans out. Let's not put our money there. I really am actually expecting this not to see as much of a surge. That being said, they have some really excellent things in the pipeline that are going to be coming out next year, lots of new rides and shows. So I do think we'll see, this won't be a couple year thing for them, but it might not recover until fourth quarter maybe.
Yeah, no, kind of lost in all of this is the news that originally hit Disney before coronavirus took over all the headlines that Bob Iger would be stepping down. The stock fell a little bit on that, and still we're seeing it fall more and more as the headlines continue to shift. But Kelly O'Grady, thank you so much for joining us. Appreciate you taking the time. Coming up, more on President Trump's push to eliminate payroll taxes, how much it could cost, and why it won't be as effective as a short-term economic boost. The Director of Economic Policy Studies at AEI joins us for more on that. Wi-Fi PM is back in 2.
I'm a United States Army veteran, and 2005, 2006 served in Iraq, and 2008, 2009 I was a homeless veteran. Thanks to the folks at Veterans United, my wife and our kids and I now proud homeowners. I couldn't have done it without them. They made the process easy and helped us realize a dream that we didn't really think was possible. So no matter how low you get and how bad things are, just remember there's always hope.
Welcome back to Wi-Fi PM. President Trump is renewing his call for a payroll tax cut amid the coronavirus outbreak. He wrote on Twitter earlier today saying, quote, "If you want to get money into the hands of people quickly and efficiently, let them have the full money that they earned. Approve a payroll tax cut until the end of the year, December 31st. Then you are doing something that is really meaningful. Only that will make a big difference." Guys, he has been pushing, both him and Treasury Secretary Steve Mnuchin have been pushing for the payroll tax cut here and eliminating that to free up some stimulus for the American public. But a lot of questions about whether or not that will actually lead to anyone actually going out and spending that money rather than just saving it. But not a lot of other policy decisions or policy tools right now being discussed in the White House, it sounds like.
Right, and I think that is the big question, you know, that really gets to the heart of it, is how much will putting more dollars in consumers' pockets help? Because in this case, it is a problem of zero demand in certain cases. You know, if people don't want to be on airplanes at all, people don't want to be on cruises at all, or doing certain other, you know, leisure activities because of the coronavirus, that isn't necessarily going to help the industries that are most affected by this. So it gets to the question of how effective is this?
It's very unlike what we saw before when President Bush signed the stimulus measure to send checks to people. It wasn't as if there was a fear of going out and traveling.
Yeah, I mean, so basically the challenge is that we're in this do or die moment, this kitchen sink moment where we're expecting a big coordinated policy response from all parts of government in order to make this happen. Now, ideally, this happened earlier, maybe last week or earlier this week, but that's really what the market expects. From a payroll tax cut perspective, I guess the question is, how do you make this as targeted as possible? Or how do you do it as early as possible if the administration can just flip on a switch and make it happen tomorrow? And I think in this case, there's both will people spend the money, but also if you can target it to folks who would have a cash crunch and prevent that from happening, that would be probably the #1 goal at this point.
Yeah, and that's, I mean, it's kind of tough to figure out who that's going to be in all of this right now as well. We do know the industries that are going to be most impacted, but in terms of putting a dollar price tag on the idea of suspending payroll taxes, I want to bring in Yahoo Finance's Kristen Myers, who joins us now with the numbers behind that, because Kristen, the Penn Wharton budget model is out with new data, just trying to rack up how much this might actually cost.
Yes, because you know I always love to talk about how much things cost. So Penn Wharton budget model decided to crunch the numbers on this payroll tax holiday, and they essentially said it was going to cost over $800 billion. If we want to put a very specific number, $807 billion is going to be the cost of this payroll tax holiday that's going to run. They approximated from April 1st, so we're not quite there yet, all the way through to the end of the year, December 31st. Now, just to put this into context of how big that is, back in 2008, when we saw the bailout of the banks, of Freddie and Fannie Mae, that would only cost $634 billion. That's according to ProPublica. The numbers kind of skew a little bit on that 2008 bailout. The numbers range up to as high as $700 billion, but still much lower than what we are seeing from this bailout. Now, you guys have been talking about how targeted this is going to be. Here's the thing. This payroll tax holiday would only impact the bottom 20% of that income distribution. Only 2% of those folks would actually get a tax cut. This actual tax holiday skews towards the top 10%, which actually gets over 25% of the tax cut. 25.2% of the top income earners in the United States would actually receive that payroll tax cut. Now, Zach, you and I have talked about this previously. A payroll tax holiday sounds really nice. Here's the problem. One, you actually have to be working in order to receive a payroll tax holiday. And so for people that have gotten their hours reduced or are no longer working because of this benefit doesn't really apply to them anymore at all. And then when you have to consider the actual amount of savings that you're getting. So the Penn Wharton budget model actually crunched the numbers on that. The average tax saving for someone in that bottom wage quarter, you can call it, or that wage group, that bottom group, savings is only $320 on average, but it's over $14,000 for those top wage earners.
Yeah, and the other thing, too, that we got from Speaker Nancy Pelosi was that she was saying that they were close to reaching an agreement with the White House on a coronavirus bill. She's spoken to Treasury Secretary Stephen Mnuchin about it 5 times already today. But, I mean, when we talk about Republicans, Democrats agreeing here, it sounds like Democrats are pushing much more actively for the idea of securing paid sick leave for employees that might not have that right now, and that seems to be on the forefront of their mind. Any ideas on where they might agree in getting some aid through? I think we're going to wait and see if Kristen Myers can get that connection reestablished there. But for right now, I mean, that has been the push between Republicans and Democrats, has been paid sick leave or payroll taxes. And neither one necessarily, I mean, you can make the argument that paid sick leave makes a lot of sense to at least make sure that workers who can't show up to work continue to get paid. And that's very important when you think about demand shocks and everything else here. But the idea that more wouldn't be put into public health push, we saw the $8 billion that was passed last week, but more questions being raised right now about where that money is going in terms of more active research on the vaccine front or making sure that testing is actually expanded as well, because there are a lot of concerns that not enough tests are out there.
Definitely. And, you know, I think especially with testing, that is a huge point. And part of this is having accurate information, having an accurate data set of exactly how many people have the coronavirus, what the infection rate actually is. I think that will do a lot in order to put the public's mind at ease in terms of, you know, how widespread this actually is.
On the front of payroll taxes, just want to put one more pin in this. So joining us now for more insight is the Director of Economic Policy Studies at the American Enterprise Institute and author of the new book, The American Dream is Not Dead. Michael Strain joins us now. And Michael, you said pretty fervently in a Bloomberg opinion piece that you do not agree with the idea of President Trump's payroll tax cut proposal. We just heard a little bit about why that might be here. But what if not that? If not payroll taxes, what else should be on the president's desk here to solve this?
Well, I think we need to find a way to put money in people's pockets. There are going to be people who are hourly wage workers who aren't going to be able to go to work. And that's going to be a serious economic problem for them because they have bills to pay and food to buy and all sorts of things. We also don't want people who are sick to feel like they have to go to work because, again, if they're hourly wage workers, because if they don't go to work, that means that they won't be able to earn an income. So we need to find a way to get money to people who need it so that they can make it through this crisis. A payroll tax cut is not a crazy idea, but a payroll tax cut would not help the non-employed elderly because they're not working. There are no payroll taxes to cut. And bear in mind, of course, that the elderly are a population that's at the most risk from the coronavirus. It would not help the unemployed because they have, again, no withholding to reduce. So it's just not the best solution. Instead, what we should be doing is in states that are experiencing severe outbreaks, if you're a low-income worker, the government should just send you some cash so that you can weather this.
And Michael, quick question around that. So operationally and mechanically, for the administration to do this, I mean, it seems like the payroll tax cut is just something they can't control immediately, especially when we're dealing with, you know, a public health crisis with exponential growth, and we always, at any point, should have acted yesterday. So to the extent that, you know, we're balancing speed versus targeting the right people, I guess what do you make of that? Are there things that we could do very quickly, but would also target the right populations?
I mean, we can do cash very quickly. You know, if you do the targeting based on whether or not you're in a state with a severe outbreak, and the CDC can
400 people in Washington. That's crazy.
And whether or not your household income is below a certain level, which is information that the government has, you could do targeting. You can get that money out the door quickly. There are other things we should be doing too. So in order to receive unemployment insurance, you have to be actively looking for work. You have to be applying for jobs.
Yeah.
We should suspend that requirement for workers who are laid off. And who are receiving unemployment checks. Congress should not require them to be actively looking for work. That's one way to get more money into people's pockets who are economically vulnerable, and it's another way to reduce the spread of the virus because you don't have sick people out there going on job.
Yeah, you would like the idea of the economic incentives here to align with the public health incentives here as well. So that's kind of why we're talking about paid sick leave. But interesting to hear Secretary Mnuchin talking about why he didn't want to do that in the first place, why he didn't want to just send money everywhere. It sounded like because they may not have realized how important or how critical this crisis would become. But when you look at pointing out some of the problems with the progressive or regressive way, I should say, that more wealthy people would actually receive more when you think about payroll tax reductions in this. Is there a way to just send the money specifically to those people when we talk about schools getting shut down, those on the poverty line? depend on the meals that are in schools. I mean, is there a way, and how much money would you actually say that this would cost comparing to the $807 billion we were just talking about on the payroll tax side? How much would it cost?
So one thing you could do is you could send more money to households with children, right? So if you are, again, a low-income household and you're in a state with a severe outbreak, a household with, 2 people gets this much money, a household with 3 people gets this much money, with 4 people gets this much money, and you escalate that for precisely that reason, because a lot of kids in low-income households depend on free and reduced-price lunch and breakfast, and you don't want parents going to work in order to put food on the table.
Yeah.
You want parents to be able to stay home with their kids or to stay home because they're sick, and so we can target that. How much would it cost? I mean, it would be much cheap. The idea that I'm suggesting would be much cheaper than the president's idea to waive the entire employer and employee payroll tax. But it's very difficult to put a price tag on the idea I'm suggesting, because we just don't know how many states are going to end up with severe outbreaks.
Mm-hmm.
Right now, it's not that many, but that number could either grow a lot or a little over the coming couple of weeks, and I think we just don't know at this point because we don't have the testing capability up.
Yeah, absolutely. And when we talk about the exponential increase of cases here, that's why it's important to maybe put some of these things into practice to prevent people who are sick to go to work and make sure that they're still making that money that they need to put food on the table. But for now, we're still going to wait and hear what the president has to say just a couple hours away from his address. Michael Strain, thank you so much for joining us and giving us that, though.
Thank you.
Appreciate
Thank
the
you
time.
so much.
Meantime, next on Wi-Fi PM, Warren Buffett's annual shareholders meeting, the latest to announce it will lock out attendees. We're still going to carry the meeting right here exclusively on Yahoo Finance, but in the sell-off, the Oracle of Omaha is not saying he is shedding his airline stocks. Stick around to hear why right after this. Welcome back to Wi-Fi PM. Right now we're checking the markets, and you can see the Dow still maintaining its rally, the rebound from yesterday's worst sell-off since 1987. You can see up by about 900 points. The S&P and the NASDAQ in the green as well, but we are awaiting that Trump news conference coming at 3 p.m. We'll see what happens as he plans to reportedly declare a national state of emergency over the coronavirus outbreak. He's scheduled, of course, to take the podium at 3 p.m. Eastern Time. Meantime, though, when we talk about all of the stocks that have been sold off and all the investors panicking right now, one man is not. Warren Buffett is announcing he is going to be changing his annual shareholders meeting due to coronavirus, the outbreak that we've seen. But he has said that the meeting will still happen as planned, and we will still bring it to you. On May 2nd, no shareholders will be physically allowed to attend, but the streaming will continue right here on Yahoo Finance as originally planned. The one thing that he did say, though, that was interesting about panicking over all this, he said that he is not planning to do so in a new interview with editor-in-chief Andy Serwer about how airlines are performing amid the coronavirus pandemic. Take a listen.
Damn, look at that.
Yeah, I want to go through some of these businesses because you have big stakes, and you mentioned airlines, for instance. Let's just start with
That's
that.
money right
Delta's
there.
a
Let's see
big
what's
holding. You have holdings in the other 3 big ones as well.
Sure.
And so how do you assess what's going to happen, and does that change your outlook?
Well, it's going to be terrible. But I've always felt a pandemic would happen at some time. I mean, I've actually used that term. I mean, in describing things that can interrupt the progress of not only this country but the world. It won't stop the progress of the country or the world. I mean, this is a terrible event that's occurring. We don't know how terrible, and it may not turn out to be that big a deal when we get through, but it may turn out to be a very big deal, and we just don't know. And I certainly don't know, and nobody knows. But there will be other things that happen in the world in the next 5, 10, 20 years. That's the way the world works. It's not a totally even course. The progress of mankind.
S&P is scary, man.
And that won't stop. I mean, you flew out here, yesterday or today, and you flew over a country that 250 years ago, there wasn't anything here. That's only 3 of my lifetimes, and there wasn't anything here. And now you've got all these bountiful farms, and you got 260 million vehicles in the country, and you got 80 million owner-occupied homes, and you've got 155 million or whatever it is, million people working, and I mean it's incredible. I went, when I had a medical check the other day, I went to incredible medical facilities that are just 2 or 3 minutes from here, and that wasn't here. Wasn't even here 100 years ago, and so we keep making progress. We haven't forgotten how to make progress in this country, and we haven't lost interest in making progress, and that will benefit to varying degrees all kinds of people, including around the world. But there will be interruptions, and I don't know when they will occur, and I don't know how deep they will occur. I do know they will occur from time to time, and I also know that we'll come out better on the other end.
So it doesn't sound like you're selling airline stocks today.
I won't be selling airline stocks.
There you go, a nice sigh of optimism there from the legendary Warren Buffett, and you can catch more coverage of our exclusive interview with the Oracle of Omaha right here on yahoofinance.com. Well, after the break, we're talking how to play defense amidst the coronavirus sell-off. A top portfolio manager breaks down the strategies for any time horizon you might have. Wi-Fi PM is back in 2. Good afternoon and welcome to Wi-Fi PM. I'm Zach Guzman, and joining me today is Yahoo Finance's Emily McCormick, along with Clearonomics founder, CEO James Liu, back with us in studio. Right now, breaking news as Bloomberg reports President Trump plans to declare a national emergency over the coronavirus outbreak.
National emergency. Let me look at the stocks.
At 3 p.m. Eastern time. As you can see, the Dow recovering here, up by about 1,000 points as the S&P and the NASDAQ recover in kind as well. But amid all the recent market turbulence,
3 p.m., right?
Americans are checking their 401ks, retirement accounts, to see some tough realities right now, maybe, depending on how you're invested. But our next guest says now is not the time to panic and start selling. Joining us to discuss is Heller Wealth Management President Larry Heller. Larry, good to see you.
Thank you for having me here.
Yes, of course. Right now, it would be a good time to discuss defense and strategies around all this as we're entering a bear market. So what are you telling clients and what people should be doing out there?
Well, obviously not to panic. And if you're investing in your 401k and you have a long time, we tell people this is a great time to invest. Equity should be investing for a long time. I'm glad I followed Warren Buffett because he doesn't panic and he buys companies that have been beaten up. So we're suggesting the same thing. In fact, I think you have a chart that shows that anytime we've had a correction of 10 or 15 or 20%, the next 1, 3, and 5 years have outperformed. So now is the time to be either jumping in or actually looking at your allocation.
Larry, if you're someone who is in retirement now or retiring within the next year, though, and you see this market volatility, how do you actually respond to that, and where do you move your money, if at all?
Yeah, great question. So we work with a lot of retirees. So the one thing we do is suggest that you have 3 years of your annual expenses in cash and short-term bonds. So this way you can ride out any of these downturns. So it may be a little too late to doing that, but hopefully you've done that, because we haven't gotten any phone calls. Our clients are trained to know that. Of course, when the market was flying, everyone was not so happy to have it in cash. But that's what I would suggest that you have.
So 3 years about what you're trying to do there in the short term. Because, I mean, when we talk about this, the average length of a bear market, 21 months, basically, is what we're looking at there. But of course, you know, you shouldn't really be banking on your stocks here to get you through the tough times. When you're flipping the equation, though, and talking to millennial investors, maybe people who haven't experienced a bear market before, what's the advice to them if they have a much longer time horizon?
Yeah, it's kind of funny because I think I've come full circle. My first week in the business was October 1987. So I wish I knew then what I know now. So for the millennials, I would definitely, give into it hurts. If you're not maximizing what you have, please maximize what you can. If you look at your asset allocation and rebalance into equities now, you have a long time before you have to withdraw money. So that's what I've been telling all millennials.
And Larry, I mean, we know that so much of investing is psychological, not checking your 401ks. What other tips would you have for people or, to try to stay the course while this is all happening?
Well, I mean, again, that's behavioral finance. Everyone wants to get out when things are doing bad and go in when things are doing well. And you want to do just the opposite. We're going to have some volatility short term. So your investing now is not for short term, it's for long term. So invest and not worry about the ups and downs that's going to happen.
In terms of allocation, though, when you're looking at where to put this money, right now we've looked at it, obviously the energy sector got hit very hard because of the collapse in oil prices, but outside of that, is there any specific sector that you're looking at, maybe names that you've seen a lot of interest from clients realizing that this may be a short-term blip?
Yeah, I've given up a long time ago trying to figure out which sector. So I think, going diversified portfolio
This is
a
crazy,
much better
man.
way of going. And you want to do the asset allocation a little bit between maybe fixed income and equities and not really worry about which sector.
And you'd mentioned starting your career in 1987, so you've experienced a number of downturns. Do you see this one following a similar playbook and a similar recovery strategy for investors and trying to figure out what to do next?
Yeah, it's interesting because every time we've had one of these, clients say, well, this is different. The tech bubble is different in 1980. Well,
and this one's the fastest. I mean, this is the fastest we ever went from a peak to a bear market.
Right. 2007 might have been different because it was a financial crisis. But again, we'll get through this just like we did at all the other times. And you don't want to wait until getting back in because the markets will move too fast for you. So take advantage of the opportunity that's in front of us now.
And it's always hard to remind yourself, but I mean, as we just heard from Warren Buffett, a longer term time horizon, a lot can change, and it's a lot of time for things to come back. But for now, Larry Heller, thank you so much for joining us.
Thank you.
Coming up, K through 12 schools in Ohio, Michigan, and Maryland, the first to announce weeks-long closures. As more employers announce work-from-home policies as well, we'll chat with Wharton's professor of management for how much it could drag down productivity and how schools are trying to shift classes online right after this.
Oh, if I do this, it'll stop my stream. I'll do it later. I thought this would have been a good buy zone once it crossed this, but I guess the way this market's set up, so volatile. Let me see what the spreads look like.
Welcome back. As the coronavirus cases continue to spread across the world, employers are scrambling to set up large capacity work from home programs to help keep employees healthy. And join us now for more on that is Peter Capelli. He's a professor of management at the Wharton School of the University of Pennsylvania. And Peter, when we look at this, I mean, not a lot of companies necessarily had these practices built in before this started to spread. So what should managers expect right now from their employees as they shift to work from home?
Well, you know, I feel great sympathy for employers on this because the population is hearing really different things from people about how bad the problem is and what's the appropriate thing to do. And, you know, a lot of people suggesting, sometimes not so subtly, that you should just sort of stay home, lock yourself up. So I think there's a lot of panic on the part of the employees. And I think one thing that employers can do is present some policies, present some information, present some things that we know right now that would be good. I think the biggest problem employers have right now with work from home policies is that they don't really have them, that they've kind of let local managers decide who can work from home, and they're really inconsistent in those policies. So in this part of the company, maybe you can, in this part doing the same work, maybe you can't, depending what your manager says. So the first thing to do is to agree these kinds of jobs you can work from home, these kind you can't, and here are the policies we're going to put in place for do it, and do it company-wide.
Yeah.
Peter, this is maybe one of the largest work from home, domestic and global experiments that we've ever had. So is there an expected impact to productivity, either for the better or for the worse as a result of this?
Well, you know, that's a great question. The evidence we've got on work from home seems to be, at the very least, that it doesn't seem to have negative effects on productivity, and some carefully done ones suggest that it's better. And one of the reasons are you're not commuting, you're not spending that time commuting, and a lot of work, frankly, is not being done because we're doing too many meetings. It's hard to do meetings when you're working at home. So I don't think we should expect it to go down. I think the problem, though, is that when you're working in a new way, whether it's remotely or just differently somehow, the problem is, are we managing people appropriately? Are we telling them, here's what we want you to do, here's the outcome we expect, here's how we're going to measure how you're doing? And if we're not doing that stuff, you know, even in your regular office, you might be having lousy productivity, but we just haven't paid much attention to it. So it's also an opportunity to shape up and say, let's get real about performance management.
Yeah, and anecdotally, I mean, we've been hearing a lot this week about people who actually might have experienced a boost in productivity because they don't have the distractions that might come with working in the office. But in your years studying all of this, outside of productivity, are there any failures to avoid for companies trying to put this in place? Maybe certain anecdotes that you've seen for just all-time worst work-from-home policies?
That's a good one. I think that the worst ones are just letting local managers decide. That's the most common one, too. And there are some managers who just believe in principle that people are watching Gilligan's Island when they're not in the office. And these are folks who believe in FaceTime, right? That we measure your performance by whether you're at your desk, and the longer you're there, the worse it is. So, or the better your productivity is. So I think that's the biggest, is we just have let local managers make their own call without any evidence whatsoever. And I'd say that that's pretty common. You know, I think the other thing to be clear about, though, is let's really figure out which jobs can only be done from the office. And in those contexts, the next step is to think about, okay, who's going to do them? What happens, sort of replacement planning, if this person gets sick? And there's actually an opportunity there, and that is to give people who have not maybe done that complete job before the opportunity to step into it, even if it's on a temporary basis.
Yeah, for sure.
And see what they can do. We've been very reluctant to do that. These are kind of stretch assignments. We haven't done that very often, but now we got an opportunity, we might as well take advantage of it.
Absolutely. All right, Professor Peter Capelli, thank you so much for breaking all that down. Appreciate you taking the time there. Meantime, it's not just offices that are getting impacted by this as well. Schools are scrambling. We've seen a few K-12 schools in Los Angeles, Ohio, Michigan, and Maryland announcing weeks-long closures as part of a broad attempt to contain the spread of the coronavirus. And it comes as many universities are transitioning to all online classes as well in a bid to avoid face-to-face instruction. Joining us now to discuss is a professor at Columbia University's Teachers College, Lalitha Vasudhaivan, along with Yahoo Finance's Reggie Wade. And Professor, I'll just start with you because we're seeing a lot of schools have to do this. What kind of changes do you think is going to be coming down the line to make this, I don't know if it's going to be smooth, but what can be done to try and make it smooth as we shift online?
Well, I think what you just said, it's not going to be smooth. And I think a lot of people are recognizing that what we need to do right now, first and foremost, is recognize that this bumpy time that we're in is going to be bumpy for a while. And I think universities are doing a really good job, or they're trying to, by communicating. I think your last guest talked about the need for really open communication, the need to be really clear about what is expected, what resources are available. And we're also seeing a lot of peer-to-peer sharing of resources. And so part of what I keep seeing over and over again, both in my own university, but also with colleagues around the country, and in some cases around the world, as the whole world is grappling with this, are questions of not only how do we retain a kind of commitment to the educational practices and that we want to promote and cultivate with our students, but how do we do that in this time with limited resources, because we also can't assume the resources that our students have. And I think that's the thing that's coming up, that a lot of people are coming up against. How do we continue to maintain quality of instruction while still attending to the many ways in which our students might be limited in the way that they can access the kinds of instruction that we're able to offer?
Yeah, not easy. And I know, Reggie, I mean, you were a teacher before too, so you know this better than anybody.
Yes, and Professor, I want to ask you, as a former teacher, I know that student engagement is key to a quality education. Do you feel that some of the technologies that are at your disposal as a professor up to the task of doing this large online education?
Yeah, you know, for over a decade, probably a couple of decades now, universities have been playing with and increasing their use of different technologies, different platforms, different ways of creating more forms of participation. And we have a lot of experts here at our college and around the country and around the world who are thinking about how do you use technology to lower barriers to participation. And really, technology in education can be used to create more inclusive environments, to increase participation. What happens now, what is happening now, right now, is an emergency situation. We are encountering not the ideal contexts and conditions for experimenting with tools and technologies, but many of my colleagues around the world are facing this kind of urgency to continue, to continue education, engage in academic continuity, while still trying to figure out, and for many of them, new tools. And so one of the things that I'm seeing happening is this kind of call for simplicity over sophistication, this reminder that what we need to do in this first hurdle is to just stay connected, to be clear and communicative with our students, with our colleagues, our institutions, and to do what we can to be supportive, because many of our students, we have graduate students here at Teachers College, they are also adults with families and responsibilities. And so as we're experiencing this kind of urgent call to go online and remote learning, as your guest just talked about, many companies and organizations are also going on to remote learning. So we are having to negotiate this kind of commitment to academic equity, right, with all these other forces at play.
No, it's very tricky, and it's one thing to teach college online. It's a totally different thing to teach second grade online. I don't know if that's as doable here, but Professor, thank you so much for sharing your thoughts on that, along with Reggie Wade. Appreciate you taking the time in. And we want to give an update on the coronavirus outbreak from New York Governor Andrew Cuomo. Just a few moments ago, he announced that New York State now has 421 confirmed cases of coronavirus, more than any other state in the U.S. That's up from 325 cases just yesterday. Governor Cuomo also says New York City has 154 cases, up from 95. More Wi-Fi PM right after this, and more on the decision from New York City to ban anything going on Broadway. We'll discuss that next.